Hey everyone, Professor Reiko here again, continuing on with our videos on our long-term liability chapter. We're focusing in on bonds payable. Last video we talked about the issue price. Now we're going to take it a step further and start walking through the journal entries, start adding some more terms, and kind of start expanding our problem here. All right, so journal entries for the bonds. So if you watched the last video, you'll notice here this information right here, the 100,000 8% 10-year bonds, semi-annual interest, market rate is 10%. That's the exact same problem we used at the end of the previous video. Okay, so I do that just to when I'm doing it in class and I'm doing several of these at one time and an extended lecture. It just helps keeps things straight using the same bonds. So what we're going to do here is we're going to look at it at 10%, which we know that's a discount because remember when the market rate is greater than the stated rate, that means you're paying less than the market. You have to offer it at a discount. And then down at the bottom, we're just going to change the market rate and look at it as a premium. All right. So real quick, if you remember, if you watched the last video, you already know this, but the first thing we always do in a problem is calculate the interest payment. Remember, investors will pay, meaning we can sell our bonds or issue our bonds at the present value of the expected future cash flows. And there's two cash flows, the face value, which is the 100,000, and then the interest. Okay. So remember, interest is principal times rate. And remember, we only use the stated rate to do this calculation. That's the only time we use the stated rate in the problem, times time. So it's semi-annual interest, so it's 6 of the 12 months, right? Meaning half of the year. So 8% essentially is the full year, 4% is semi-annual interest. So we get $4,000. Right, we already did that in the previous video, but just in case you didn't see that one, I encourage you to go back and watch the second video. But if not, that's how we get the interest payment. So I always do that first because it's the only time I use the stated rate. All right. Also, we already did this in the previous problem as well, so I'll just sketch it out real quick. That's 4,000. Okay, payment is the semi-annual interest payment. Your calculator is reading it as the annuity. So if you're using the present value tables, you'll want to go to the ordinary annuity table. This is our future value. Okay, I put these both as negative, as I said in the last video, because I do it as it is a cash flow to me. We are the people issuing these bonds, which means we are going to pay $4,000 out every 6 months and pay $100,000 at the end of the life of the bonds. N represents the number of periods. Make sure you understand that's not number of years. There's 10 years, but that means there's 26-month periods. And then the market rate is the market rate for the period. So the market rate is 10. So the market rate every 6 months is 5. Right? So when you put all that into your calculator, and then if you hit the compute button and present value, it's going to kick this out. All right? So I don't teach using the tables typically, especially when you get to intermediate 2 topics. I think it's easier to use it's definitely easier and much quicker to use a financial calculator, so I encourage you to get one. However, this one right here would be the present value of an ordinary annuity table. This will be the present value of $1 table, or present value of a lump sum, whatever your book calls it. All right, and if you do that, you have to go to each of those tables, get the factor for the intersection of 20 and 5. Take that factor times each of those numbers respectively, and then add that together. All right, so you can see that's a lot more work. You're still going to get the correct answer. However, I strongly encourage the tables. I'm sorry, I strongly encourage the use of the calculator. All right, so on January 1, my journal entry to issue the bonds. All right, so once again, if you struggle with journals, you just think what's going on here. Right, I'm issuing bonds, which means I'm getting cash. All right, I'm always getting cash for the issue price. So that number you calculator is my cash number. Skip a space here. I always credit bonds payable for the face value of the bonds, right, which is 100,000. And then you can see my difference here of 12,462 is my discount. And we just call that discount on bonds payable. All right. So if you have already done the investment chapter, that's going to be a mirror image of what you did in the investment chapter. But this is now our long-term liability chapter, so we're going to focus on it from that perspective. All right, so there's two different ways to amortize your discount and recognize interest expense. There's the straight line method, which we'll use that as our baseline because it's easy. But then the effective interest is the one we'll focus on. It'll be the one in future videos, and I'm sure more than likely it'll be the one your teacher focuses on come test time. All right, so straight line, take the discount. Oops, let me scribble that out. 12,462, and divide it by the number of periods, which is 20. Okay, so that works out to be $623.10. All right, so what that means is when we get to our interest dates, all right, so every 6 months we are going to recognize interest expense and we're going to pay out our $4,000 in interest. All right, so the journal entry is going to look like this. All right, so I don't know interest expense yet. That's going to be a debit. I'm amortizing my discount, so that discount is essentially a contra liability, which means it's a debit balance because liabilities are credit balances. So a contra would be a debit. So to reduce that, when we amortize it, we'll need to credit it. So I'm going to do that for 623. I'm going to leave off the 10 cents because it doesn't matter for this journal entry. And then I'm crediting cash for the 4,000. That number I've already determined. So that's the amount that I'm sending to my investors every 6 months. I'm amortizing 623, which makes this 4623. This is essentially a plug number, which means it's just the number that makes my journal entry balance. All right, so you can see I pay more interest, have higher interest expense, I should say, as a result of the discount. When I have a premium, you'll see I'll have less interest expense, so I kind of benefit in that way when I have a premium. All right, so we would do, now it's straight line, which means this journal entry would be the same every 6 months till the end of the life of the bonds. All right, so we'll just skip ahead now and try to figure out what is our unamortized discount. So just think about, our discount T account. All right, we started with 12,462. We just amortized 623 of it. It is now down to 11,839. All right, so you can see it's going down as we're amortizing it. And then that allows us to get the carrying value of the bonds. So the carrying value is the face value of the bonds minus the unamortized discount. All right, so face value of these bonds were 100,000. The unamortized discount is 11,839. So that means the carrying value at this point is 88,161. So we'll see this once we start doing effective interest. Your carrying value is always approaching face value. So in this case, it starts below face value and will work its way back up. Think about it. At the end of the life of the bonds, this unamortized discount will be 0. So your carrying value will equal your face value of 100. Okay, and that's another good thing. And the reason I do this too is because that's always a good multiple choice question. I could give you this information and say what is the carrying value of the bonds after the first interest payment. Well, you'd have to know all these journal entries up here, but you wouldn't have to write them out. You would just really be trying to figure out how much you amortize and then make sure you understand how to define the carrying value of the bond. All right, so let's switch gears here and do a premium real quick. All right, so notice we're doing the same information. All we're doing is changing the market rate, all right, to 7%. Okay, so my payment doesn't change because remember, my payment is based on the stated rate. We haven't changed the stated rate. We've only changed the market rate. The future value is still 100. All right, the number of periods is still 20. But now my market rate is 3.5. So when you run that through, you get 107, 106. Okay, so that makes my journal entry to record that. All right, so I'm still going to have my debit to cash. And remember, my debit to cash is always my issue price. All right, skip a space. Bonds payable is always face value. So you can see I'm off by 71.06, and that's going to be my premium on bonds payable. All right, so let's flip over to the next page real quick and finish this one out as well. So straight line amortization, we'll take the 71.06, divide it by 20, and that works out to be 355.30. All right, so our journal entry is going to look similar, except we have a premium now. So this will be on July 1st. We're still going to have interest expense, and that's still going to be a plug number, and that I'm going to put in a second. All right, we know the premium is going to be $355, and once again, I'm going to leave off the change. And then my cash Now notice this number doesn't change because I didn't change the stated rate of the problem. All I changed was the market rate. All right, and so my plug number now is 3645. So we could do this journal entry over and over again. All right, so the unamortized premium and carrying value now is we started with 7106. We just amortized 355. So this account has gone down to 6751. All right, and it would continue going down every time that we amortize it. All right, so the carrying value, remember it's face value. Remember it was you would subtract an unamortized discount or add an unamortized premium. That's a little sloppy there. That's PREM for premium. All right, so we have 100,000 plus the 6751 will be 106,751. So notice now the carrying value will be going down towards face value. At the very end, the unamortized premium right here will be 0, so it'll be 100 plus 0 or 100,000. All right, so when we start setting our effective interest tables up in our coming videos, we'll see that a little bit. It'll be a little clearer to see because we'll do more than one period. All right, so that's straight line amortization. Like I said, your teacher will probably go through straight line. But then once we get to effective interest, that's probably what they'll expect to see on the test. Now, look, it's important to remember, when we do effective interest, our journal entry is going to be the same. The only difference is these two numbers right here are going to change every time. So we'll see that in the coming videos. All right, so hopefully this helps kind of get you going on your bonds payable, how to account for them, how to record all the journal entries, understanding your carrying value of your bonds, and things like that. All right, so I hope you're enjoying. Please share these with your friends in your class. Hopefully it will help them as well, and be sure to subscribe to the channel. All right, thank you. I'll see you next time.